The Stock Market Playbook: How to Start Investing in Stocks. This audiobook is written and produced by Wealth Books. Introduction. In this audiobook, we'll cover everything you need to begin your investing journey. Many individuals believe that investing in stocks is complex and reserved for experts, but that is simply not the case. You do not need a finance degree, a large bank account, or hours of daily research to get started. What you do need is knowledge, a solid grasp of the fundamentals, intelligent risk management strategies, and a clear understanding of how to establish achievable goals. And that is precisely what we are here to offer. We will guide you through how the stock market operates, how to choose stocks, how to open a brokerage account, and most importantly, how to make informed decisions with your hard-earned money. Throughout this process, we will also explore managing emotions, diversifying wisely, and maintaining a long-term perspective. Essential principles that will pave the way for enduring success. Whether you are a complete novice or seeking to refine your approach, this audiobook is crafted to provide you with practical, easy-to-understand guidance. By the conclusion, you will be prepared to take that initial step towards investing with confidence and achieving your financial objectives. Chapter 1. Why invest in stocks? Before delving into the intricacies of stock investment, let us first examine why investing in stocks stands out as one of the most potent tools for accumulating wealth over time. While the concept of investing may seem intimidating, grasping the underlying reasons behind it can significantly simplify the commitment to the process. So what exactly makes investing in stocks a worthwhile consideration? The power of compounding and long-term growth. To begin with, let us address the aspect of growth. A primary motivation for individuals to invest in stocks lies in their historical potential for long-term growth. Despite daily fluctuations in stock prices, the stock market has demonstrated a consistent upward trend over extended periods, rebounding from significant crises such as the 2008 financial meltdown and the recent COVID-19 market crash. This sustained growth can be attributed to the phenomenon of compounding. When you invest in stocks, your returns do not merely accumulate, they compound. Compounding occurs when the returns generated from an investment start to generate their own returns. For instance, if you earn a return on your investment this year, that return can itself yield a return the following year, creating a compounding effect that augments your wealth over time. This is why many view compounding as the magic of investing, allowing your initial investment to burgeon into a substantial sum in the future. Stocks outperform other asset classes over time. Another compelling rationale for investing in stocks stems from their track record of outperforming other asset classes. Stocks typically offer higher returns compared to bonds, real estate, or savings accounts. Historically, the stock market has delivered an average annual return of 7 to 10% adjusted for inflation, whereas bonds may yield around 2 to 5% and savings accounts even less. While past performance doesn't guarantee future results, stocks have a proven history of delivering strong returns to patient investors. These higher returns can make a significant difference over decades of investing, especially when combined with the power of compounding. Stocks give you the best chance of growing your wealth over time, making them a fundamental component of many retirement and long-term saving strategies. Preserve your purchasing power and beat inflation. Investing in stocks serves as a means not only to grow your wealth, but also to safeguard the value of your money. With inflation typically hovering around 2 to 3% annually, the dollar you hold today will inevitably lose value over time. If your funds are idly sitting in a savings account yielding close to 0%, you are essentially losing money in terms of purchasing power as time progresses. Stocks present an opportunity to combat inflation by generating returns that, on average, outpace inflation rates. By delving into the world of stocks, your money stands a chance not only to keep pace with inflation, but also to appreciate in real value, thereby preserving and enhancing your purchasing power in the long run. Ownership in companies and dividends. When you invest in a company's stock, you are acquiring a small stake in that company. Should the company thrive and prosper, you stand to benefit directly from its success, be it through potential stock price appreciation or, in certain instances, dividends. Dividends represent regular payments disbursed by a company to its shareholders, typically on a quarterly basis, as a means of distributing profits. Investing in stocks not only grants you a sense of ownership, but also a vested interest in the growth of some of the world's most prominent companies. This ownership can yield returns through both stock price appreciation and dividends, which can be reinvested to further fuel growth. Flexibility and accessibility. In comparison to other investment avenues, stocks offer a high level of flexibility and accessibility. With just a few clicks on your phone or computer, you can buy and sell stocks whenever the market is open. This renders stocks a highly liquid asset, enabling you to swiftly convert them back into cash if the need arises. Unlike real estate, which may necessitate weeks or months to sell, stocks can be sold within seconds. Investing in stocks offers the potential for growth, the preservation of the value of your money, ownership in companies you believe in, and the opportunity to build a future of financial security. It is a proven strategy for accumulating wealth over time, despite the inevitable fluctuations in the market. The potential rewards of investing in stocks make it a journey worth embarking on. In the upcoming chapters, we will delve into the practical steps needed to begin your investment journey. We will cover topics such as setting investment goals, understanding risk, selecting a brokerage account, and more. By the end of this guide, you will possess the necessary tools and confidence to initiate your own investment journey. Chapter 2. Understanding the stock market. The stock market may appear complex, but at its core, it serves as a marketplace where individuals can buy and sell shares of publicly traded companies. In this chapter, we will delve into the intricacies of the stock market, including its functions, key players, and factors that can influence stock prices. Let's get started. What exactly is the stock market? Essentially, the stock market comprises exchanges where shares of publicly traded companies are bought, sold, and traded. Companies list their stocks on these exchanges to generate funds for growth, expansion, and day-to-day operations. When you purchase a share of stock, you are acquiring a small ownership stake in that company. The most renowned exchanges include the New York Stock Exchange, NYSE, and the Nasdaq, both situated in the United States. However, stock markets are present worldwide. Each exchange serves as a platform for companies to go public, offering shares to the public for the first time through an initial public offering, IPO. Subsequently, these shares become accessible for everyday investors to engage in buying, selling, and trading. Key players in the stock market. The stock market is an intricate ecosystem with a multitude of key players who perform vital roles in its operation. Understanding the roles of these players can provide valuable insights into how stock prices fluctuate. Individual investors. These are individuals like you and me who invest in stocks to grow their savings and achieve financial goals. Institutional investors. Large organizations such as mutual funds, hedge funds, and pension funds manage significant amounts of money in the stock market. Their trading activities can impact stock prices due to the sheer volume of stocks they buy and sell. Market makers. Financial institutions or individuals who facilitate trading by ensuring there is enough liquidity in the market. They play a vital role in maintaining smooth trading processes and preventing price gaps. Brokerages. Companies that provide platforms for investors to trade stocks. They act as intermediaries connecting individual investors with the stock market and charge fees or commissions for their services. Regulators. Organizations like the U.S. Securities and Exchange Commission, SEC, oversee the stock market to ensure fairness, transparency, and compliance with regulations. Each of these players has a unique role in the stock market ecosystem, working together to keep the market efficient and functional. Understanding their functions can provide valuable insights for investors looking to navigate the complexities of the stock market. Determining stock prices. Understanding how stock prices are determined is essential for any investor. Stock prices are constantly changing throughout the trading day, driven by the forces of supply and demand. When there is a higher demand for a stock than there is supply, the price will rise. Conversely, if there are more sellers than buyers, the price will fall. But what influences these shifts in supply and demand? Market sentiment is the key driver behind stock price movements. Market sentiment is shaped by various factors, including company performance. A company's financial performance, such as revenue, growth, and profitability, directly impacts its stock price. Positive performance can attract investors, leading to an increase in stock prices, while negative news can cause a decline. Economic indicators. Factors like employment rates, inflation, interest rates, and GDP growth have a significant impact on how the market is perceived. Positive economic news tends to drive stock prices up, while negative news can result in declines. Global events. Events like wars, natural disasters, and pandemics can have far-reaching effects on stock prices by disrupting business operations, supply chains, and consumer behavior. Investor psychology. Emotional factors, such as fear and greed, also play a crucial role in stock price movements. Optimistic investors tend to buy stocks, driving prices higher, while fear can lead to selling and price declines. Market news and analyst ratings, news reports, analyst ratings, and earnings announcements can all trigger significant price swings. For example, an analyst's upgrade of a stock's target price can boost demand and drive up prices. In essence, stock prices are the result of a complex interplay of factors, decisions and emotions made by millions of investors based on real data, forecasts and sentiments. Understanding these dynamics is essential for navigating the stock market successfully. Types of stock markets: primary versus secondary. In the world of stocks, there are two primary markets, the primary market and the secondary market. Let's delve into the distinction between the two. Primary market. This is where companies offer their shares to the public for the first time through an initial public offering, IPO. When a company decides to go public, it issues shares in the primary market. Investors who purchase these shares are buying directly from the company. Secondary market, commonly known as the stock market. The secondary market is where investors trade shares amongst themselves rather than directly from the company. This is where the majority of trading occurs, and where stock prices fluctuate based on supply and demand. Understanding this differentiation sheds light on why stock prices move. In the primary market, companies determine the price, while in the secondary market, prices are influenced by investors' perceptions of value. Stock market indices. To gauge the performance of the stock market, we look at stock market indices. These indices consist of selected stocks that represent specific segments of the market. For instance, 1. The Dow Jones Industrial Average, DJIA, comprising 30 large publicly traded companies in the US. This index is often used as an indicator of the US economy's health. 2. The S&P 500, consisting of 500 of the largest US companies. The S&P 500 is widely regarded as a comprehensive representation of the US stock market. 3. The Nasdaq Composite, encompassing all companies listed on the Nasdaq exchange, with a strong focus on tech companies. Each index offers insight into the performance of a particular market segment. When people mention that the market was up today, they are typically referring to one of these major indices. Bull and bear markets. In discussions about the stock market, two terms that are frequently mentioned are bull market and bear market. These terms are used to describe the general trends in the stock market. A bull market refers to a period when stock prices are on the rise or are expected to rise. This upward trend is typically fueled by investor optimism, economic growth, and strong company performance. Conversely, a bear market is characterized by falling stock prices or an expectation of decline. Bear markets can be triggered by economic slowdowns, high inflation, or other negative events. While both bull and bear markets are natural components of the investing cycle, having a clear understanding of them can help you avoid making emotionally driven decisions during times of market volatility. Stock market risks and volatility. Investing in the stock market comes with inherent risks, as prices can be unpredictable and subject to volatility. While some factors can influence the market in predictable ways, others, such as sudden economic downturns or global crises, are more challenging to anticipate. Volatility measures the extent to which stock prices fluctuate. During periods of high volatility, prices can swing widely in a short time frame, which can be unsettling for investors. However, Volatility also presents opportunities to purchase stocks at lower prices and sell them when prices increase. Effectively managing risk involves diversifying your investments, understanding your tolerance for price fluctuations, and adhering to a long-term investment strategy. Understanding market hours and after-hours trading. In order to make informed investing decisions, it is crucial to have a solid understanding of market hours and after-hours trading. The US stock exchanges, such as the NYSE and Nasdaq, operate from 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. However, there are additional after-hours and pre-market trading sessions available for investors. During after-hours trading, which occurs before and after regular market hours, investors can buy and sell stocks. It is important to note that trading volume during these times is typically lower, leading to higher price volatility. While after-hours trading is primarily utilized by institutional investors, many online brokers now offer individual investors the ability to trade during these sessions. It is essential to understand that prices can be more volatile and less predictable outside of regular trading hours. Having a solid grasp of how the stock market operates is fundamental to navigating the world of investing with confidence. By understanding key concepts such as how stock prices are determined, who the major players are, and what influences market movements, investors can make more informed decisions. This knowledge serves as the foundation for successful investing strategies. Chapter 3. Setting your investment goals. Now that you understand the basics of why investing in stocks is important and how the stock market works, it's time to get clear on your investment goals. Defining your goals is one of the most crucial steps in your investment journey. Your goals will shape your strategy, inform the types of assets you choose, and keep you focused on the bigger picture, especially when the market is volatile. In this chapter, we'll discuss why setting goals is essential, how to define them, and the steps you can take to tailor your investment approach based on your personal financial ambitions. Why setting goals matters. Investing without clear goals is like setting off on a road trip without a map. Without a defined destination, you're likely to take unnecessary detours, waste time, and feel uncertain about whether you're moving in the right direction. Clear investment goals provide a roadmap for your financial journey and give you the focus you need to stay on track. Well-defined goals help you make informed decisions. When you know what you're aiming for, it's easier to choose investments that align with your objectives. Manage risk appropriately. Different goals call for different risk levels. Long-term goals may allow for more risk, while short-term goals might require a conservative approach. Stay motivated. During times of market volatility, knowing your goals can help you stay focused and avoid making impulsive decisions. Measure progress. Clear goals allow you to track your progress and adjust your strategy as needed. In short, your goals act as a personal compass, guiding you through the ups and downs of the stock market. Types of investment goals. Your investment goals can be short-term, medium-term, or long-term. Understanding the difference is essential because each type of goal may require a different strategy. Let's break down each category. Short-term goals. 1. 3 years. Short-term goals are typically those you hope to achieve in the next few years. Examples include saving for a vacation, a car, or a wedding. Since these goals are close in time, it's generally advisable to choose investments with lower risk, such as bonds, high-yield savings accounts, or short-term certificates of deposit, CDs, as they are less likely to lose value in a market downturn. Medium-term goals. 3. 10 years. Medium-term goals might include things like a down payment on a house, a dream vacation, or starting a small business. Since you have more time to ride out market fluctuations, you might consider a mix of stocks and bonds to achieve a balance of growth and security. This time frame gives you some flexibility to take on more risk while still protecting your capital. Long-term goals. 10+ years. Long-term goals usually revolve around retirement, funding your child's education, or achieving financial independence. For these goals, you can afford to take on more risk and allocate a larger portion of your portfolio to stocks, as they offer the potential for higher returns over the long run. Over decades, even the occasional downturn tends to be balanced out by periods of growth, making stocks a suitable choice for long-term wealth building. Defining your personal goals. Now that you know the types of investment goals, it's time to define your own. Start by thinking about what you want to accomplish with your investments. Take a few moments to consider the following questions. What are your financial priorities? Write down your priorities. Is paying off debt important to you? Are you focused on building an emergency fund, buying a home, or retiring early? Listing your priorities will help you identify where to channel your resources. How much money do you need? For each goal, estimate how much money you'll need to reach it. If you're saving for a house, look at average home prices in your desired location. If you're planning for retirement, consider your lifestyle expectations and estimated annual expenses. What's your timeline? Assign a time frame to each goal. The timeline influences the types of investments you'll choose and your approach to risk. The more time you have, the more aggressive you can afford to be in your investment strategy. What's your risk tolerance? Consider how comfortable you are with taking risks. Some people are fine with seeing their portfolio fluctuate in the short term as long as they're on track for long-term growth, while others prefer stability, even if it means lower returns. Are you open to adjusting your goals? Life circumstances change, and it's important to know whether you're flexible with your goals or if they're non-negotiable. For example, you may decide that retiring at a specific age is a top priority and adjust other goals accordingly. These questions will help you outline your goals and make them as specific and actionable as possible. Smart goals for investing. To make your goals even more effective, consider using the SMART framework. SMART goals are specific. Clearly define what you want to achieve. Instead of "I want to save money," try "I want to save $20,000 for a home down payment." Measurable. Quantify your goals so you can track your progress. For example, "I want my portfolio to grow by 7% annually." Achievable. Set realistic goals based on your financial situation. If you're starting with a small amount, don't expect to double it overnight. Relevant. Ensure your goals align with your long-term financial plan and personal values. Time-bound. Set a deadline for each goal. This will help you stay focused and allow you to adjust if you fall behind. SMART goals can transform vague aspirations into concrete targets, giving you a clear direction and path forward. Aligning goals with investment strategy. With clear goals in place, you can now align them with your investment strategy. Here are some examples of how different goals might shape your strategy. Retirement, long-term goal. For a goal like retirement, you might focus heavily on stocks in your portfolio to maximize growth over the years. You might also consider tax-advantaged accounts, such as a 401k or IRA, to grow your investments tax-free or tax-deferred. Down payment on a house, medium-term goal. For a medium-term goal like a down payment, consider a balanced portfolio with a mix of stocks and bonds. This allows you to take advantage of growth opportunities while keeping some of your money in less volatile assets to protect your savings. Emergency fund, short-term goal. Your emergency fund is meant to be easily accessible, so you'll want to keep it in a low-risk, liquid investment like a high-yield savings account or money market fund. Each goal has unique requirements, and your strategy should reflect the balance of risk, time, and expected return that aligns with your financial aspirations. Regularly. Reviewing and adjusting your goals. Setting investment goals isn't a set-it-and-forget-it process. It's important to review your goals regularly to make sure they're still in line with your financial situation and life changes. Major life events, like a job change, marriage, buying a home, or having children, might require you to adjust your investment plan or add new goals. Many investors choose to review their portfolio and goals annually, making sure they're on track and that their investments still align with their objectives. By taking the time to reflect and adjust, you ensure your investments are working toward your real-life goals, not just numbers on a spreadsheet. Setting investment goals is an empowering step. It gives you a roadmap to guide your investment choices, manage risk, and stay committed, even during market downturns. Remember, these goals are personal to you, so it's okay if they're different from others. What matters is that they're aligned with your own financial vision. Chapter 4. Types of stocks and investment options. This chapter will cover common types of stocks, such as growth and dividend stocks, and other investment choices like ETFs and mutual funds. Understanding these options will help you build a diversified and resilient portfolio that aligns with your goals and comfort level with risk. Common stock versus preferred stocks are the primary way that individuals invest in companies, and they generally fall into two categories: common stock and preferred stock. Each type has unique characteristics and can serve different roles in an investment portfolio. Common stock. Common stock is what most people think of when they talk about investing in the stock market. When you buy common stock, you own a small share of the company and can benefit from increases in the company's value, which ideally increases the stock price. Common stockholders often have voting rights in the company's decisions, although your influence will be limited if you're a small shareholder. One of the key aspects of common stock is its potential for capital appreciation, meaning that its value can increase over time. However, it's also subject to market fluctuations, so it can be more volatile than preferred stock. Preferred stock. Preferred stockholders have a higher claim on a company's assets and earnings than common stockholders, particularly in the event of liquidation. Preferred stock is often seen as a blend between common stock and bonds. While preferred stocks do not generally offer voting rights, they provide a more stable income stream in the form of fixed dividends. This makes preferred stock a good choice for investors looking for income stability, though it typically has less growth potential compared to common stock. Types of common stock: growth, value, and income stocks. Within common stocks, there are different categories based on the company's characteristics and the investor's goals. Let's explore the three main types: growth stocks, value stocks, and income stocks. Growth stocks. Growth stocks belong to companies expected to grow significantly faster than the average market rate. These companies often reinvest their earnings back into the business rather than paying out dividends. Examples include tech companies or startups in emerging industries. Growth stocks can offer substantial returns, but they also carry higher risk and tend to be more volatile. Investors with a long-term horizon and a higher tolerance for risk often favor growth stocks. Value stocks are shares of companies that investors believe are undervalued relative to their fundamentals, such as earnings and sales. These companies may have experienced recent setbacks or operate in less glamorous industries. Investors buy value stocks with the expectation that the market will eventually recognize the company's true worth, causing the stock price to rise. Value investing appeals to those who want to buy stocks at a discount and can wait for their true value to emerge over time. Income stocks. Income stocks are shares in companies that consistently pay dividends, providing a regular income stream. These stocks are often associated with more established companies in industries like utilities or telecommunications. Income stocks can be appealing for investors looking for steady returns, especially those nearing retirement. While they may offer less growth potential than growth stocks, income stocks provide stability and predictable earnings through dividends. Blue chip stocks and small cap stocks. In addition to growth, value, and income stocks, investors may also encounter terms like blue chip stocks and small cap stocks, which describe the size and reputation of the company. Blue chip stocks. Blue chip stocks are shares in large established companies with a history of stable earnings, consistent dividends, and strong performance. These companies, like Apple, Coca-Cola, or Procter & Gamble, are well known and are often leaders in their respective industries. Blue chip stocks are generally considered a safer investment because of their stability and ability to weather economic downturns. They are ideal for conservative investors looking for steady growth and reliability. Small cap stocks. Small cap stocks are shares in companies with a relatively small market capitalization, typically under $2 billion. These companies are often newer or in the early stages of growth, offering the potential for substantial gains. However, small-cap stocks tend to be riskier and more volatile than blue-chip stocks, making them better suited for investors with a higher risk tolerance. Small-cap stocks are a popular choice for investors looking to take advantage of growth opportunities that larger, established companies might not offer. Other investment options: ETFs, mutual funds, and index funds. While individual stocks offer the potential for high returns, they also come with significant risk. Many investors choose to diversify their portfolios with additional investment options like exchange-traded funds, ETFs, mutual funds, and index funds. Exchange-traded funds, ETFs are collections of assets, usually stocks or bonds, that are traded on the stock market. They allow you to own a diversified range of investments within a single fund. ETFs track specific indices, sectors, or themes, providing exposure to a broad selection of companies without needing to buy individual shares. Because they're traded on exchanges, ETFs are flexible and can be bought or sold throughout the trading day, just like individual stocks. They are popular for their low fees and versatility. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. Managed by professional fund managers, mutual funds aim to achieve a certain investment objective, such as growth or income. Unlike ETFs, mutual funds are typically bought and sold at the end of the trading day, and they can come with various fees. They are a popular choice for investors who prefer to leave investment decisions to professionals. Index funds. Index funds are a type of mutual fund or ETF designed to replicate the performance of a specific index, like the S&P 500. Because they simply track an index rather than being actively managed, they often have lower fees than actively managed funds. Index funds are a good choice for investors seeking broad market exposure with low costs. By holding a portfolio that mirrors the index, they offer diversification and reduce the risk associated with individual stock selection. Bonds, real estate, and alternative investments. In addition to stocks, ETFs, and mutual funds, other investment options can complement your portfolio and further diversify risk. These include bonds, real estate, and alternative investments. Bonds are loans you give to companies or governments, which they repay with interest over time. They're generally seen as safer than stocks, though they usually offer lower returns. Bonds are useful for investors looking for steady income or a conservative investment option. There are various types of bonds, including government, corporate, and municipal bonds, each with unique risk and return profiles. Real estate investment involves purchasing property, such as residential or commercial buildings, with the expectation of generating income through rental payments or property appreciation. Real estate can provide steady cash flow, tax benefits, and potential capital gains. It also has the added benefit of being a tangible asset. Real estate investment trusts, REITs, are another way to invest in real estate without directly purchasing property, offering liquidity and diversification. Alternative investments. Alternative investments include a variety of asset classes such as commodities like gold or oil, hedge funds, private equity, and cryptocurrency. These investments are generally riskier and less liquid, but can be valuable for diversification. Alternative investments may be suitable for experienced investors looking to diversify further or hedge against market downturns. Choosing the right mix for your portfolio. Each investment type we've discussed, stocks, bonds, real estate, and alternatives, has unique characteristics and risk factors. The best investment mix will depend on your individual goals, time horizon, and risk tolerance. Here are some tips on building a balanced portfolio. Diversify across asset classes. By combining stocks, bonds, and possibly real estate or alternative investments, you can balance potential gains with stability. Consider your risk tolerance. If you're comfortable with higher risk, growth stocks and small cap stocks may be appealing. If you prefer stability, blue chip stocks, bonds, or ETFs with a conservative focus might suit you better. Align with your goals. If you're saving for retirement, long-term growth-oriented investments may be suitable. For short-term goals, you may want to focus on safer options like bonds or dividend-paying stocks. With a solid understanding of various investment options, you're now equipped to make choices that align with your financial goals and personal risk tolerance. By exploring a range of stocks, funds, and other assets, you can build a portfolio that's as unique as you are. In the next chapter, we'll focus on managing and assessing risk in your investment choices. Whether you're a cautious investor or willing to take more chances, understanding risk is key to making confident investment decisions. Let's dive in. Chapter 5. How to open a brokerage account. By now, you have a clear understanding of the stock market, different types of investments, and the importance of setting goals. Now it's time to talk about the next essential step: opening a brokerage account. Think of a brokerage account as the gateway to the world of investing. It's the account through which you'll buy, sell, and hold various investments, from stocks and bonds to mutual funds and ETFs. This chapter will guide you through the types of brokerage accounts, how to choose a broker, and the steps to open your account. Let's jump in. What is a brokerage account? A brokerage account is an investment account that allows you to buy and sell securities such as stocks, bonds, and mutual funds. Unlike a typical savings account at your bank, a brokerage account is designed to facilitate active trading and long-term investing. When you open a brokerage account, you're connecting with a financial firm, often referred to as a broker, that executes trades on your behalf and offers access to a variety of financial products. In simple terms, a brokerage account is where you'll keep the money you plan to invest, much like a wallet for your financial assets. While there are different types of brokerage accounts designed to meet various financial goals, they all serve the same fundamental purpose: providing you with a platform to access the financial markets. Types of brokerage accounts. There are several types of brokerage accounts to consider, each with distinct features designed for different purposes. Let's go over the main types to help you determine which one suits your goals best. Individual taxable brokerage accounts. Individual accounts, also known as taxable brokerage accounts, are the most common type. These accounts are open to individuals and provide complete flexibility, allowing you to buy and sell investments with no restrictions on contributions or withdrawals. Any gains, dividends, or interest earned in these accounts are subject to taxes, hence the name taxable account. However, you're free to withdraw funds at any time, making them a good choice for general investment purposes or short to medium-term goals. Joint brokerage accounts. Joint accounts are opened by two or more people, commonly spouses, and allow both individuals to access and manage the account. There are two primary types of joint accounts: joint tenants with rights of survivorship, JTWROS, where ownership passes to the surviving account holder upon the other's death, and tenants in common, TIC, where each owner has a defined share. Joint accounts are ideal for couples or business partners looking to pool investment resources. Retirement accounts. If your goal is retirement savings, tax-advantaged retirement accounts like individual retirement accounts, IRAs, are an excellent choice. Traditional IRAs allow contributions to grow tax-deferred, meaning you pay taxes when you withdraw in retirement. Roth IRAs, on the other hand, are funded with after-tax dollars, allowing your contributions to grow tax-free. 401k plans, typically offered by employers, are another option, providing tax-deferred growth and, in some cases, employer matching. Custodial accounts. Custodial accounts are designed for minors, allowing parents or guardians to invest on behalf of their children. Common types include the Uniform Gift to Minors Act, UGMA, and Uniform Transfers to Minors Act, UTMA accounts. These accounts can be used to save for a child's future expenses such as education and give the child full control once they reach the legal age, typically 18 or 21, depending on the state. Education savings accounts. These accounts, such as 529 plans or Coverdell Education Savings Accounts, ESAs, are designed to help families save for education-related expenses. Contributions to 529 plans can grow tax-free and be used for qualified education expenses without tax consequences. While these accounts are not strictly brokerage accounts, They can hold a range of investments like mutual funds and ETFs, making them a valuable option for investors focused on education savings. Choosing the right brokerage firm. With so many brokerage firms available today, selecting one that matches your needs and preferences is crucial. Here are some key factors to consider when choosing a brokerage firm. Fees and commissions. Many brokerage firms have shifted towards zero-commission trading for stocks and ETFs, but fees can still vary widely depending on the type of account and trades you make. Look for firms with low fees, especially if you're planning to trade frequently, and check for additional charges, such as for account maintenance, options trading, or fund transfers. Account minimums. Some brokerage firms require a minimum deposit to open an account, while others have no minimum. If you're starting with a small amount, you might prefer a firm with no or low minimums. This can help you begin investing with less upfront capital. Investment options. Different brokers offer varying selections of investment products. If you're interested in specific types of investments, such as international stocks, fractional shares, or certain mutual funds, make sure the brokerage you choose offers these options. Ease of use and platform features. If you're a beginner, a brokerage with a simple, user-friendly platform might be ideal. Many brokers provide tools, resources, and research to help investors make informed decisions. Some platforms offer robust trading and charting tools that might appeal to more experienced investors. Customer support and educational resources. If you're new to investing, consider a brokerage firm with strong customer support and educational resources. Many brokerages offer live chat, phone support, and educational articles, videos, and webinars to help you learn the ropes and feel confident in your decisions. Specialized accounts or features. Some brokerage firms offer unique accounts or features, such as robo-advisors, retirement accounts, or options for international investing. If these are important to you, make sure the brokerage you select has these capabilities. Steps to open a brokerage account. Once you've selected a brokerage firm that meets your needs, opening a brokerage account is a straightforward process. Here are the typical steps to get started. Complete an online application. Most brokerage accounts can be opened online in just a few minutes. The application will ask for basic information such as your name, address, date of birth, social security number, and employment details. This information is required for tax and regulatory purposes. Choose the type of account, depending on your goals. Select the type of brokerage account that best fits your needs, whether it's an individual taxable account, retirement account, or another option. If you're not sure, most brokerage websites offer guidance to help you pick the right type. Verify your identity. To comply with regulatory requirements, brokerage firms will ask you to verify your identity. You may need to upload a copy of your driver's license or other government-issued ID. This step is usually quick, but make sure you have the necessary documents on hand. Fund your account. After your account is approved, you'll need to deposit funds before you can start investing. Most brokers offer multiple funding options, including electronic transfers from your bank, wire transfers, and even check deposits. Decide how much you want to start with and transfer the funds to your new account. Explore the platform. Once your funds are available, take some time to explore the platform's features and tools. Many brokerages offer tutorials to familiarize you with their layout, trading tools, and research options. This exploration phase can help you feel more comfortable before making your first trade. Funding your account and setting up auto-invest. After your account is funded, you may want to consider setting up automatic contributions. Auto-investing is a simple way to contribute regularly to your account and stay consistent with your investment plan. Many brokers offer the option to set up recurring transfers from your bank account, allowing you to invest on a schedule that works for you. Investing consistently, even with small amounts, can help build your portfolio over time. For example, if you set up an automatic transfer of $100 per month, you'll be consistently adding to your investments without needing to remember each month. Placing your first trade. With funds in your account, you're ready to make your first investment. Here's a quick overview of how to place a trade. Research your investment before buying. Make sure you understand the stock, ETF, or fund you're interested in. Most brokerage platforms provide research tools, including stock ratings, analysis reports, and financial data to help you make informed choices. Choose the type of trade. There are different types of orders you can place. For beginners, a market order is the simplest, as it buys the stock at the current market price. If you want to specify the price at which you're willing to buy or sell, you can use a limit order. Take time to understand each order type to ensure it aligns with your strategy. Enter the trade details on your brokerage platform. Select the stock or asset you want to purchase. Enter the quantity and specify your order type. Double-check the details before finalizing. Review and submit. Once you've entered your trade details, review the information and click Submit or Buy to place your order. Most platforms will confirm your order and you'll be able to see your holdings once the trade is completed. Opening a brokerage account and making your first trade might seem like a big step, but with the right preparation and understanding of the process, it can be straightforward and empowering. By selecting the right account, exploring your options, and gradually building your portfolio, you're setting a strong foundation for your investment journey. Chapter 6. How to research stocks. Researching stocks may sound overwhelming at first, but it's an essential skill for any investor. Knowing how to evaluate a company's financial health, competitive position, and growth potential can help you make informed investment decisions and avoid potential pitfalls. This chapter will walk you through the steps of researching stocks, including key financial indicators, valuation metrics, and other factors to consider when selecting stocks for your portfolio. Why research matters. The importance of thorough research can't be overstated. Investing in stocks without understanding the companies behind them is like putting your money on a random bet. Stock research helps you assess a company's potential for growth, profitability, and long-term sustainability. By examining the fundamentals and valuation of a stock, you gain a clearer picture of what you're investing in and can better align your investments with your financial goals and risk tolerance. Fundamental analysis versus technical analysis. There are two primary approaches to researching stocks: fundamental analysis and technical analysis. Each method provides unique insights and has its own strengths and weaknesses. Fundamental analysis. Fundamental analysis involves studying a company's financial statements, competitive position, industry, and overall economic conditions. The goal is to evaluate the intrinsic value of the stock, which can be compared to its current market price to determine whether it's undervalued or overvalued. Investors who use fundamental analysis focus on the long-term potential of a stock, looking for companies with strong financials, good management, and growth opportunities. Technical analysis. Technical analysis, on the other hand, is focused on stock price trends and trading volumes rather than a company's financial health. This method uses historical price data and patterns to predict future movements. Technical analysts believe that all relevant information is already reflected in a stock's price, and that patterns can provide insights into potential price direction. Technical analysis is often used for short-term trading rather than long-term investing, making it popular among day traders and swing traders. For most long-term investors, fundamental analysis is the preferred approach, though some combine aspects of both methods to inform their investment decisions. Key financial statements to analyze. When researching stocks, financial statements are a valuable starting point. Let's look at the three main statements: the income statement, balance sheet, and cash flow statement. Each provides insight into different aspects of a company's financial health. Income statement. The income statement, also known as the profit and loss statement, details a company's revenue, expenses, and net income over a specific period, usually a quarter or year. It shows how much money a company made, revenue, how much it spent, expenses, and its profit, net income. Key metrics to focus on include revenue or sales, the total income generated by selling goods or services. Look for steady or growing revenue as a positive sign. Gross profit margin. This is revenue minus the cost of goods sold, divided by revenue. A high gross profit margin indicates the company is effectively controlling production costs. Net income, the company's bottom line, showing its profitability after all expenses. Consistent growth in net income suggests a healthy business. Balance sheet. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. It shows what the company owns, assets, owes, liabilities, and the equity held by shareholders. Important metrics include current ratio. Calculated as current assets divided by current liabilities, this ratio measures a company's ability to meet short-term obligations. A current ratio above 1 is generally a good sign. Debt-to-equity ratio. This measures a company's leverage by dividing total debt by shareholders' equity. A high ratio indicates more debt, which can be risky during downturns. Shareholders' equity. This represents the residual interest in the company's assets after deducting liabilities. Steady growth in equity is typically a positive sign. Cash flow statement. The cash flow statement tracks the inflows and outflows of cash, showing whether a company is generating sufficient cash to maintain operations and invest in future growth. Focus on these three areas. Operating cash flow, cash generated from regular business activities. Positive and increasing operating cash flow is essential for long-term sustainability. Investing cash flow, cash used for investments in the business, such as buying equipment or property. A high investing cash flow may indicate growth investments. Financing cash flow, cash from issuing debt or equity or repaying debts. While debt financing is common, heavy reliance on it can be a red flag. Key financial ratios and valuation metrics. In addition to examining financial statements, understanding key ratios and valuation metrics can help you assess a stock's value and growth potential. Here are some commonly used metrics to know. Price to earnings (PE) ratio. The PE ratio compares a company's stock price to its earnings per share (EPS). A high PE ratio may indicate high growth expectations, while a low PE could suggest that the stock is undervalued. However, it's important to compare the PE to similar companies in the same industry, as PE norms vary by sector. Price to sales (PS) ratio. The PS ratio divides the company's market capitalization by its total revenue. This ratio is helpful for assessing companies that may not yet be profitable but have growing revenue. Like the PE, a low PS may indicate a potential bargain. Price to book (PB) ratio. The PB ratio compares the company's stock price to its book value, or equity. It's often used for asset-heavy industries like banking or manufacturing. A PB ratio below 1 can indicate an undervalued stock, though it's important to consider the quality of the company's assets. Return on equity, ROE. ROE measures how effectively a company uses shareholders' equity to generate profits. Calculated as net income divided by shareholders' equity, a high ROE is typically a sign of efficient management. Dividend yield for income investors. The dividend yield shows how much a company pays in dividends relative to its stock price. A high dividend yield can be attractive, but it's essential to assess whether the company can sustain or grow its dividends over time. Earnings per share (EPS) growth. EPS growth measures the rate at which a company's earnings per share is increasing. Strong EPS growth can signal that the company is expanding and could be valuable for growth-oriented investors. Qualitative factors to consider. While financial metrics provide a solid foundation, it's essential to look beyond the numbers. Qualitative factors often reveal insights about a company's long-term prospects. Here are some areas to explore. Competitive advantage. Does the company have a strong market position or unique qualities that set it apart? Competitive advantages like brand reputation, intellectual property, and market dominance can provide stability and growth potential. Companies with a strong moat, a unique competitive edge, are more likely to withstand competition and thrive over the long term. Management team. A company's leadership plays a critical role in its success. Research the background, experience, and track record of the executive team. Companies with a visionary, capable management team often outperform those with weaker leadership. Industry position and trends. Understanding the company's industry and its current trends can help gauge its growth potential. Is the industry expanding? Are there any emerging trends or technologies that the company can leverage? For example, renewable energy companies are well positioned in an industry with significant future growth potential. Risks and challenges. Assessing risks is as important as identifying growth factors. Research any potential challenges the company may face, such as regulatory issues, competitive threats, or dependency on specific suppliers. Knowing these risks can help you make a more balanced investment decision. Company culture and values. Some investors are interested in environmental, social, and governance (ESG) factors, examining how companies treat their employees, impact the environment, and manage corporate governance. ESG investing is a growing trend, as many investors prefer to support companies that align with their values. Using research tools and resources. You don't need to go it alone. There are many research tools available, both free and paid, that can help you gather and analyze data about stocks. Here are a few resources to consider. Brokerage research tools. Many brokerages provide extensive research tools, including stock screeners, financial data, analyst ratings, and earnings reports. Take advantage of these features. They're often free for account holders. Financial news and websites. Sites like Yahoo Finance, Morningstar, and MarketWatch provide up-to-date financial news, stock analysis, and tools. Following financial news helps you stay informed about market trends, company announcements, and economic events that could impact your investments. Stock screeners. Stock screeners allow you to filter stocks based on specific criteria such as PE ratio, dividend yield, or market cap. Screeners are useful for narrowing down a list of stocks that fit your investment criteria, making research more efficient. Analyst reports and ratings. Many financial firms and independent analysts publish reports and provide buy, hold, or sell ratings for stocks. While analyst opinions should never be your sole guide, they can offer valuable perspectives, especially when backed by in-depth research. Earnings calls and reports. Listening to earnings calls or reading earnings reports can provide valuable insights directly from the company's executives. These sessions discuss recent financial performance, plans, and challenges. Many companies archive these on their websites or share them on financial news platforms. Conducting stock research might seem overwhelming at first, but remember, it's a skill that improves with practice. As you continue exploring different companies and analyzing their financials, you'll become more comfortable and confident in making informed investment decisions. Researching stocks is about finding the right investments for you, aligning with your goals, and growing your financial knowledge along the way. Chapter 7. The Power of Compound Interest. If you've heard people talk about building wealth, you've probably heard the phrase compound interest. Albert Einstein allegedly called it the eighth wonder of the world, and with good reason. Compound interest is one of the most powerful forces in investing, enabling your money to grow exponentially over time. In this chapter, we'll dive into what compound interest is, why it's so impactful, and how you can harness its power to build your wealth. Let's get started. What is compound interest? At its core, compound interest is interest earned on both the initial investment or principal and any accumulated interest. Unlike simple interest, which is calculated solely on the principal, compound interest adds the interest back to the principal, allowing your money to grow on top of itself. This compounding effect means your investments can snowball over time, creating exponential growth. For example, if you invest $1,000 at a 5% annual interest rate, you'll earn $50 in the first year. With compound interest, that $50 gets added to your initial $1,000, making your new balance $1,050. In the next year, interest will be calculated on $1,050 instead of just $1,000, generating slightly more interest each year as your balance grows. Over time, compounding can create a dramatic difference in your investment growth. The earlier you start, the more powerful the effect, as your money has more time to compound. How compound interest works. To understand the true potential of compound interest, let's break down how it works in 3 simple steps. You begin with an initial investment or principal. This could be a lump sum, such as a one-time investment of $1,000, or it could be the balance of your brokerage or retirement account. Unlike simple interest, where you earn interest only on the original principal, compound interest calculates interest on the total balance. Your initial investment plus any interest earned previously. The frequency with which interest compounds plays a significant role in how quickly your investment grows. Compounding can occur annually, quarterly, monthly, daily, or even continuously. The more frequently interest is compounded, the faster your balance grows. For example, daily compounding will yield more than annual compounding, as the interest earned is added to the balance more frequently. The time factor. Start early, grow big. One of the most crucial aspects of compound interest is time. The earlier you start investing, the more time your money has to grow. This is because compounding has a cumulative effect. The interest you earn in each period builds upon itself, resulting in exponential growth over time. To illustrate the importance of starting early, let's consider two investors, Alice and Bob. Alice starts investing $1,000 per year at age 25 with an annual return of 7%. She continues investing until she's 35, at which point she stops but lets her investments grow without adding any more funds. Bob waits until he's 35 to start and invests $1,000 per year until he turns 65, also earning an annual return of 7%. By age 65, despite investing for fewer years, Alice will end up with significantly more money than Bob, thanks to the early start and extra compounding time her investments enjoyed. Starting early, even with small amounts, is one of the most effective strategies to maximize the benefits of compound interest. This principle is especially important for retirement accounts and other long-term goals, as the compounding effect is exponential over time. Compound interest in different types of investments. Compound interest isn't limited to traditional savings accounts. It can work its magic across a variety of investment types. Here are a few examples of where you can leverage compound interest. Dividend reinvestment. When you invest in dividend-paying stocks or funds, you can reinvest those dividends back into the same investment. This increases the number of shares you own, allowing your investment to compound as those new shares generate their own dividends. Over time, this can significantly boost your returns. Growth stocks. Growth stocks may not pay dividends, but offer the potential for capital gains. Reinvesting profits from selling these stocks or continually adding funds to your portfolio can have a compounding effect on your wealth. While not a direct form of interest, the reinvestment of earnings functions similarly to compounding. Mutual funds and ETFs. Many mutual funds and exchange-traded funds, ETFs, automatically reinvest any income or capital gains back into the fund, which increases your holdings over time and compounds your returns. Look for funds with automatic reinvestment options to capitalize on this feature. Retirement accounts. Retirement accounts like 401(k)s and IRAs offer a double benefit. They allow investments to grow tax-deferred, and any returns are reinvested, creating a compounding effect. With tax-deferred growth, you won't owe taxes on interest, dividends, or capital gains until you withdraw funds, letting your investment compound without interruptions. Bonds and fixed income investments. Some bonds, especially savings bonds and certain treasury securities, compound interest over time. Bonds may not grow as quickly as stocks, but compounding in safe fixed income investments can be a valuable component of a diversified portfolio. Compounding frequency. More frequent equals sign, more growth. The frequency of compounding plays a critical role in maximizing returns. The more frequently interest is added to your investment, the faster it grows. For instance, daily compounding will yield higher returns than monthly or annual compounding, as interest is calculated and added more frequently. Consider this. If you have $1,000 earning 5% annually, compounded annually, you'd end up with $1,050 after 1 year. But if interest is compounded daily, you'd end up with about $1,051.27. Although it may seem like a small difference over time and with larger sums, these differences add up. When choosing investment accounts or products, keep an eye on compounding frequency. Some savings accounts, certificates of deposit, CDs, and even some investment products offer daily compounding. Opting for more frequent compounding can make a notable difference, especially over long periods. How to harness the power of compound interest. To make the most of compound interest, here are some actionable steps. Start early. The sooner you start, the more you can benefit from compounding. Whether you're contributing to a retirement account, investing in stocks, or opening a savings account, time is your greatest asset. If you're a young investor, even small amounts invested early can yield impressive results. Contribute regularly. Adding to your investments regularly increases the amount that can compound. Consider setting up automatic transfers to your investment accounts so you're consistently contributing to your growth. Even small, regular investments can grow significantly over time. Reinvest earnings. Take advantage of reinvestment options, whether through dividend reinvestment programs, DRIPs, or mutual funds that automatically reinvest gains. This will boost your compound growth as you're continually adding to the principal. Stay consistent and patient. Compounding requires patience and a long-term perspective. Market fluctuations can be unsettling, but staying invested and allowing time to work in your favor is key to benefiting from compounding. Avoid the temptation to withdraw funds early, as this interrupts the compounding process. Minimize fees and taxes. Investment fees, such as brokerage fees or mutual fund expense ratios, can reduce the compounding effect. Look for low-fee or fee-free options where possible. Tax-advantaged accounts like 401ks, IRAs, and health savings accounts, HSAs, allow your investments to grow tax-deferred or tax-free, maximizing compounding potential. Chapter 8. Long-term investing versus trading. Now that you've learned about the fundamentals of investing and the power of compound interest, it's time to explore two distinct approaches to investing: long-term investing and trading. Both methods have their own philosophies, strategies, and potential outcomes. Understanding the differences between the two will help you choose the right path for your financial goals. In this chapter, we'll define both concepts, discuss their pros and cons, and explore which approach might suit you best. Let's dive in. Long-term investing is a strategy focused on buying and holding investments over an extended period, typically years or even decades. This approach is grounded in the belief that while short-term market fluctuations can be unpredictable, the overall market tends to increase in value over the long run. Investors using this strategy often focus on fundamental analysis, selecting high-quality stocks, bonds, or other assets that are expected to grow in value over time. Long-term investors typically aim to build wealth gradually through compounding returns, reinvesting dividends, and allowing their investments to ride out market volatility. Key characteristics of long-term investing include patience. Long-term investors understand that substantial returns take time and are willing to endure market fluctuations without panic selling. Research and analysis. A focus on analyzing the financial health, competitive advantages, and growth potential of investments. Portfolio diversification. Long-term investors often build diversified portfolios to mitigate risks and enhance returns. Lower transaction costs. Fewer trades can mean reduced fees and taxes, as long-term investors often hold onto their investments for extended periods. The benefits of long-term investing. Long-term investing has numerous advantages that make it an attractive approach for many individuals. Here are some key benefits. Compounding returns. As discussed in the previous chapter, compounding can significantly enhance the growth of your investments over time. By reinvesting returns, long-term investors can accelerate their wealth accumulation. Reduced emotional stress. With a long-term focus, investors can avoid the emotional roller coaster often associated with short-term market movements. This mindset helps prevent impulsive decisions driven by fear or greed. Tax efficiency. Long-term capital gains, profits from assets held for over a year, are typically taxed at a lower rate than short-term gains, making long-term investing a more tax-efficient strategy. Lower transaction costs. Frequent trading incurs costs such as commissions and spreads that can eat into profits. Long-term investing minimizes these costs, allowing for more significant gains. Historical performance. Historically, markets tend to rise over the long term despite short-term volatility. This trend can lead to substantial wealth for patient long-term investors. The drawbacks of long-term investing. While long-term investing offers many benefits, it's not without its challenges. Here are some potential drawbacks. Long-term investors must endure market downturns and economic fluctuations. While markets generally recover, there are periods when investments can be significantly impacted. Money invested for the long term may not be readily accessible for emergencies or immediate needs. Investors should ensure they have an adequate emergency fund before committing significant capital to long-term investments. Committing funds to long-term investments may lead to missed opportunities in other areas, such as high-yield savings accounts or alternative investments that could have provided better returns in the short term. Long-term investors may need to reassess their investment thesis over time as industries evolve, technologies emerge, and economic conditions change. This requires ongoing education and vigilance. Defining trading. In contrast to long-term investing, trading is the practice of buying and selling financial instruments, such as stocks, options, or currencies, over a shorter time frame. Traders typically aim to capitalize on price fluctuations, often holding positions for seconds, minutes, hours, or days rather than years. Trading can take several forms, including day trading, swing trading, and position trading, each with its unique strategies and time frames. Traders often rely on technical analysis, chart patterns, and market sentiment to make decisions. Key characteristics of trading include active management. Traders are involved in the constant buying and selling of securities, requiring continuous market monitoring and analysis. Higher transaction volume. Trading involves numerous transactions, which can incur higher commissions and fees. Short-term focus. Traders seek to profit from short-term market movements rather than long-term growth potential. The benefits of trading can be an exhilarating and potentially lucrative endeavor. Here are some of the advantages that attract individuals to trading. Quick profits. Successful traders can generate profits quickly, sometimes within minutes or hours, capitalizing on rapid market movements. This can lead to high returns in a short amount of time. Flexibility and independence trading can be done on a flexible schedule, allowing individuals to pursue it as a full-time career or part-time venture. Many traders enjoy the independence that comes with making their own investment decisions. Variety of strategies. Traders can choose from a wide array of strategies, including day trading, swing trading, or options trading, allowing them to tailor their approach based on their skills and risk tolerance. Continuous learning. The dynamic nature of trading encourages ongoing education and adaptation. Traders often engage in a continuous learning process, gaining insights into market behavior and technical analysis. Utilization of leverage. Many trading platforms offer leverage, allowing traders to control larger positions than their initial capital. While this increases potential profits, it also amplifies risks, the drawbacks of trading. Despite its potential rewards, trading comes with several significant risks and drawbacks. Here are some challenges to consider. Higher risk of loss. The fast-paced nature of trading can lead to significant financial losses. Traders must be prepared for the potential of losing their entire investment, particularly when using leverage. Emotional stress trading can be emotionally taxing, with rapid price movements triggering fear, greed, and anxiety. Many traders find it challenging to maintain discipline and stick to their strategies during volatile market conditions. Time-intensive successful trading often requires extensive time and effort to research, analyze, and monitor the markets. It may not be suitable for those with limited time or resources. Transaction costs. Frequent trading incurs substantial commissions, fees, and taxes that can quickly erode profits. Traders must be mindful of these costs and factor them into their strategies. Lack of long-term gains. While trading can yield quick profits, it often lacks the long-term growth potential associated with investing. Traders may miss out on compounding benefits and the wealth accumulation that comes from holding quality assets over time. Choosing the right approach for you. Deciding between long-term investing and trading depends on your financial goals, risk tolerance, time commitment, and personal preferences. Here are some factors to consider. Financial goals. If your goal is to build wealth gradually for retirement or long-term security, long-term investing may be the better path. Conversely, if you're looking for short-term profits or have specific financial targets, trading could be more suitable. Risk tolerance. Assess your comfort level with risk. Long-term investing is generally less risky than trading, which requires accepting the possibility of substantial losses. If you're risk-averse, consider sticking with a long-term strategy. Time commitment. Evaluate how much time you can dedicate to managing your investments. Long-term investing typically requires less time than trading, which demands constant monitoring and analysis. If you have a busy schedule, long-term investing may align better with your lifestyle. Market knowledge. Consider your level of knowledge and experience in financial markets. Trading often requires a strong understanding of technical analysis and market trends, while long-term investing leans more on fundamental analysis and research. Emotional resilience. Reflect on your ability to handle the emotional aspects of investing. Trading can be stressful, and those prone to anxiety may find it challenging to navigate the ups and downs of the market. Ultimately, both long-term investing and trading can play valuable roles in your financial strategy. Many investors find a balance between the two, employing long-term investments for steady growth, while dabbling in trading for short-term opportunities. As you explore your options, remember that the best approach is the one that aligns with your financial goals, lifestyle, and personality. Understanding the differences between these strategies will empower you to make informed decisions about your investments.